Welcome to the latest episode of EY India Insights podcast. I'm Pallavi, your host for today. And in this episode, we're discussing hedge accounting in banks. How are they managing risk versus managing outcomes? Joining us is Hemal Shah, partner of consulting services at EY India, to share his insights on the challenges and opportunities in aligning risk management with accounting outcomes. Hi, Hemal. Thank you for joining us today and welcome to the podcast.
Hi, Pallavi. Thank you.
Thank you. So, Hemal, to begin with, what is the fundamental difference between managing risk and managing accounting outcomes, and why has this become a critical issue for banks in today's volatile interest rate environment?
Pallavi, if we look at banking as a business, at its core, risk management is all about protecting the bank from adverse movements in interest rate, currencies, and any other market variables. Banks use instruments such as interest rate swaps or other derivatives to reduce their economic risk and stabilize earnings over a period of time. However, accounting outcomes focus on how those hedging activities are reflected in the financial statements. The challenge arises because a hedge can be economically effective but may not always produce the desired accounting result. In today's environment of interest rate volatility, central bank policy shifts, geopolitical conditions, balance sheet management for banks has become very complex. Banks are increasingly focused not only on whether a hedge reduces risk, but also whether accounting treatment accurately reflects the economic reality. In simple terms, managing risk is about reducing exposures, while managing outcomes is about ensuring that the financial statements tell the same story as the risk management strategy. When those two diverge, unexpected earning volatility can occur even though the hedge is doing exactly what it is designed to do.
Thank you, Hemal. Now, why do banks sometimes experience earnings volatility even when their hedging strategies are working effectively from a risk management perspective?
This is the one of the most common misconceptions around hedge accounting. A bank may have successfully reduced its economic exposure through derivatives, but accounting rules often require different valuation approaches for the hedging instrument and the underlying exposure. As a result, gains and losses may be recognized in different periods or measured using different assumptions. For an example, an IRS may offset the risk of a loan portfolio from a treasury perspective. Economically, the bank is protected. However, if the accounting treatment of the swap and the hedged item is not perfectly aligned, profit and loss statements may still show fluctuations. So the volatility which investors see in the reported earnings does not necessarily indicate ineffective risk management. Instead, it may reflect limitations in the hedge accounting framework and complexity of matching accounting recognition with economic reality. The key objective of hedge accounting is therefore to reduce this artificial mismatches and improve transparency.
Thank you, Hemal. Now, what are the key challenges such as hedge effectiveness testing, basis risk, valuation differences, and documentation requirement that can create inconsistencies in hedge accounting outcomes?
There are several practical challenges that banks face. First is hedge effectiveness assessment. Banks must demonstrate that there is a strong economic relationship between the hedge instrument and the risk which is being hedged. Even small deviations can create accounting ineffectiveness. Second is the basis risk. This occurs when a derivative does not move exactly in line with the underlying exposure. Even though the hedge reduces most of the risk, slight differences can affect accounting results and generate the residual volatility. Third may be the valuation differences. The derivative and the hedged items may be valued using different methodologies, different market data sources or assumptions. Now, these differences can create accounting mismatches despite a successful economic hedge. And finally, the documentation and the governance requirements, which remain significant. Hedge accounting is not automatic. Banks need very clear documentation of risk management objectives, hedge designations, its methodologies, and ongoing monitoring. If documentation is incomplete or at a high level or not maintained consistently, hedge accounting treatment may not be available even when the underlying hedge strategy is sound. Together, these challenges explain why hedge accounting is often viewed as both a risk management exercise and also an operational discipline.
Thank you, Hemal. Now, one last question. Looking ahead, how can banks strengthen governance and better align treasury, risk, and finance functions to ensure hedge accounting reflects the true economic intent of their risk management strategy?
The key is to move away from siloed decision making. Treasury teams typically focus on managing funding and interest rate risk exposures. Risk teams focus on measuring and monitoring risk, while accounts and finance teams focus on the accounting and the reporting objectives. To achieve successful hedge accounting, all these three functions need to operate from a common framework and a shared objectives. Banks can strengthen governance by establishing clear hedge accounting policies, enhancing documentation standards, investing in integrated technology platforms, maybe create a bespoke technology platform, conducting ongoing effectiveness monitoring. This helps ensure that risk management decisions are reflected accurately in financial reporting. Another important step is embedding hedge accounting considerations earlier in the hedging life cycle rather than treating them as a reporting exercise at the end of the process. When treasury, risk, F&A collaborate from the outset, banks can reduce surprises, improve transparency, and better demonstrate the economic rationale behind their hedging activities. Ultimately, the goal is simple. Financial statements should reflect the true economic effect of the risk management decisions. Enabling stakeholders to understand how effectively the bank is managing uncertainty in a volatile market environment is a pure imperative.
Thank you, Hemal. Now, that brings us to the end of this episode. Thank you so much once again for sharing all your perspectives to our listeners.
Thank you, Pallavi. Thank you so much.
Thank you. And to all our listeners, thank you so much for tuning in for EY India Insights podcast. Stay connected for more conversations on the trends shaping business, risk, and transformation. Until next time, this is Pallavi signing off.